All right, let's get straight to it. We're not talking about simple stock tips today. We are going to build from the ground up a professional-grade trading plan for a giant, ExxonMobil. And look, this isn't about guesswork or speculation. It's about process. It's about discipline. It's about a strategy you can actually use.
So you've got to ask, right? What's the deal with ExxonMobil? The signals are all over the place. Is it a screaming buy, a simple hold, or is there something, well, more complicated going on here that we really need to dig into?
And here's why it's not an easy yes or no. The data just doesn't agree. You've got these mixed momentum signals. Analysts are slapping a hold rating on it. So let's be crystal clear about this. If you try a one-size-fits-all approach with this stock right now, you're making a huge mistake. Okay, so this is where we need to think like a pro. Forget just buy or sell. The real strategy here is to match your plan to who you are as an investor. And to do that, we've laid out 3 very different scenarios, 3 playbooks designed specifically for this kind of market. So let's take a look at these 3 playbooks. The first one is for the conservative type, the value and dividend investor. The second is for the aggressive trader, the one chasing momentum and breakouts. And the third, that's for the contrarian, the deep value hunter, who's waiting for the perfect opportunity. Now, this is where it gets really interesting. When you put these strategies next to each other, you see just how different they are. We're talking completely different entry points, different levels of risk, and even different profit goals. It all comes down to the philosophy you choose. Okay, here it is. This is the whole game plan on one slide, and you really need to look at the numbers. The conservative investor, they're risking about 8% to make 11%. The aggressive trader, on the other hand, risks way less, only 2.5%, for a shot at almost 13%. And the contrarian? Whoa, a potential 23% return, but they have to be willing to buy when things look ugly. This is your master grid right here. All right, let's dive into that first strategy, the conservative value and dividend plan. This is for the investor who's thinking about slow and steady growth, protecting their capital, and of course, collecting those dividend checks. So, for this plan, you're not buying at today's price. No, the number you're watching is 110.68. Now, why that exact number? Because that's the 200-day moving average. Think of it as a major support level, a line in the sand where the big money, the institutions, often start buying. And this whole strategy is about patience. You don't chase the stock, you let it come to you. That stop loss at 105.50, that's your safety net. It's not optional. If the stock breaks below that, the plan is over and you protect your capital. The goal? A simple ride back up to that 52-week high. Okay, let's switch gears completely and talk about the aggressive play. You have to understand, this is a totally different way of thinking. This is for the active trader, the person who wants faster gains, and keeps a very, very tight control on their risk. With this approach, you're not buying the dip. Forget that. You're buying the breakout. You wait for the stock to prove itself by breaking above that 115 resistance level. Yeah, you're paying more, but you're buying with confirmation that the momentum is in your favor. But you've got to be disciplined here. The entry only counts if you see a big spike in volume to confirm it. And look at that stop loss, super tight, only a 2.5% risk. This is not a buy and hold kind of thing. It's a quick tactical trade. And that profit target? It's based on what we call volatility extensions, basically a fancy way of projecting how high the stock could shoot up based on its recent moves. And that brings us to our third and final playbook, the contrarian deep value play. Now, this one is for the truly patient investor, the person who loves to buy when everyone else is panicking, to scoop up a great asset on the cheap. This strategy doesn't even come into play unless the stock gets hammered, all the way down to that big psychological $100 mark. I mean, we're talking about a 13% drop from where it is now. That kind of thing usually only happens if the whole market is in turmoil. The payoff here could be huge, a potential 23% gain just for the stock to get back to where it was. But, and this is a big but, you have to be incredibly patient. You don't just blindly buy at $100. You wait for a key signal, like insiders, the company's own execs starting to buy shares again. That's your confirmation that the smart money agrees with you. So there you have it, 3 totally different data-backed plans. The big question is, which one makes the most sense for most people right now, given what the market is telling us? Well, the data makes the recommendation pretty clear. You've got a Zacks rank of 3, which is basically hold. You have no insiders buying stock. The technicals are messy. all of that points to one conclusion. The conservative value in dividend strategy, scenario 1, is the smartest, most prudent approach for right now. And this is really the key takeaway. It's not that the other two plans are bad. They're not. Think of them as your backup plans, your contingency frameworks. You only pull them out if the market makes a dramatic move, either way up for that breakout play or way down for the deep value play.
Okay, we're almost there. But this is probably the most important part. Having a plan is great, but it's useless if you don't know when to act. So what are the exact signals you need to see before you put any money to work? This is your final checklist.
Think of these 4 triggers as your green lights. First, the price has to pull back into that entry zone, around 110.68. That's your main trigger. But to really stack the odds in your favor, you also want to see maybe a Zacks rank upgrade, or those insiders start buying again, or even the whole energy sector starting to look strong. The more of these you can check off, the better your chances of success. So, the plan is set. We've laid out the entire expert framework for you. You know the scenarios, you have the numbers, you know exactly what triggers to watch for. Now, the only question left is, which investor are you going to be? The choice is yours. The key is aligning your actions with your style and, of course, having the discipline to follow the plan.